This is my daily log. Researcher Uncle Dan, location lab. Today was another interesting day. What we observed today with Bed Bath & Beyond is we actually had a drop in implied volatility today. This is the implied volatility, this blue line. Question raised yesterday was, how do you know when to buy options? Like, when are they cheap and when are they expensive? If you have a platform which will show the implied volatility on it on a daily basis, this will give you a good idea of where the implied volatility is trading for a stock. As you can see, it was quite elevated yesterday, as well as on the day that Cohen announced he'd taken a 10% equity stake in Bed Bath & Beyond. Look at the volume on this day. Over 100 million shares traded on this day. After that, normally what you'll see and look at the implied volatility spiked way up. Normally what you'll see is a few weeks where the volatility and the stock price drifts back down. Now, I used to be a market maker, so just to let you know that normally on a day like this, when the vols explode, a market maker loses money. And so what they do is they patiently wait, because as the implied volatilities start to normalize and come back down to a more of a normal range, they'll make all those losses back. So normally what you're going to see is a spike up, and then you're going to see a week or even 2 weeks where the vols just keep drifting down. Those who are still hanging on to long call options are going to see massive theta decay in their calls. Meanwhile, those that are short the options, which will be the market makers, so within a few days, they've made all their money back that they lost in that one day. Trust me, that's how the business works. What we see here is the implied volatilities have come all the way back down, and now it's time to think about when do we make the next move up. What's interesting is today we made a new high, almost at 29. But look what happened to the implied volatility. It dropped. Normally what you'll see is the first spike up, you'll normally see a huge implied volatility jump. The second time you come up, normally you'll start to see a drop. So this is fairly normal. So you have to be careful in here. If you're buying calls, you got to be thinking about peeling some off when the implied volatility jumps up. Because today, even though the stock is higher, when the IV drops like that, your calls are not going up. And if they are going up, it's very little. You're not making 2 times, 3 times like we did yesterday. Now, why did we make so much yesterday? We had a big jump in implied volatility and a big jump in the stock price. So those are the days where you can make a lot of money, and you need to be thinking about how you can take some risk off the table, reduce your cost basis. So that's what we've got for today's log, just an observation. Where do we typically look to buy options? We're looking for a dip in implied volatility and some kind of a consolidation. You would never want to go in on a day like this. You would never want to go in and go long options with implied volatility this high. Okay, you would never want to do that. So there's a lot of variables you need to look at, but here are the simple rules. If the vols are at their all-time high, you don't buy options. If they're at all-time lows, you have a better chance. You have a better chance of making money. You're not guaranteed, but your odds are better. So that's what I have for the log today.